Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Dan Oliver of Mermican Capital. Thanks for joining me again, Dan.
Well, thanks for having me.
You know, I want to focus on an article you wrote back in January 14th titled Our Currency and Our Problem. Of course, some water has passed under the bridges since then, but that's what I'd like to focus on because I thought it was really fascinating. You start out being somewhat concerned that maybe we're going to experience the same kind of a problem. Well, it wasn't really a problem. It turned out to be very bullish for gold, but the immediate response of gold in 2008, 2009, the credit crash, was that gold also got taken down because, of course, when the margin clerk calls, you have to sell what you're able to sell, and people were able to sell gold to pay the clerk, the margin clerk. But this time you're suggesting that maybe it might be a bit different, that you're thinking gold may not be hit hard on the down, in any kind of a credit crash this time. Could you explain what your thinking is on that?
Sure. I think the operative word there is might, right? I mean, usually history does repeat itself, and the point I make in the article is that if we look at the dollar system as a system, there's about $0.2 trillion of base money. It's the monetary base, the Federal Reserve liabilities, balancing $90 trillion of debt. So when there's a credit crisis and you run out of dollars to service your debt, you need dollars, because if you don't pay your debt back, you lose your collateral. So you this giant short squeeze on dollars. And the dollar goes crazy high, and all their prices fall because, as you say, the margin clerk calls around in dollar terms. You got to sell what you can, not what you want to. Mm-hmm. And that's what happened in 2008. And I always point out, though, as part of that story, if you look at gold in real terms, like you value gold against stocks or against oil or against iron ore or copper or anything real, gold actually went shooting higher. And what I do in the gold mining space, I really care about the difference between the input prices, which are determined by base commodities, and gold, the output. So that's actually a good time for gold margins in terms of gold. It's a bad time for gold in terms of dollars. If you have dollar debt, you've got major problems. So that's been the pattern. That wasn't just 2008. That's been the pattern going back for decades. And the point I made in the article is that there are a couple of things that suggest that might not happen. It might, but it might not. And one of the reasons it might not is, first of all, gold going into 2008 was in a parabolic uptrend. So you have all kinds of debt-based investors, people who have taken out dollar loans to buy gold, and they got cleaned out. Gold has not been in a parabolic uptrend, as we all know.
Yeah, for sure.
11 years. So you don't have the same market structure of lots and lots of longs that are levered long gold. In fact, if anything, a lot of the managed money is levered short gold. And so when the margin clerk calls, they got to buy gold. So that's one difference. But the more fundamental major difference to me is when you look at the dollar as a dollar system, right? One of the things people notice, correctly so, is you look at gold in terms of other currencies, Canadian dollars, Australian dollars, Turkish lira, basically anything else, it's near its all-time highs or breaking out, going higher. So it's really only in dollar terms that it is not doing that, and that's, of course, because the dollar is the global currency to finance debt. As I was saying before, you've got all this debt in dollar terms, which is why people demand dollars. And so the question is, why is that? And that system got going really in the Bretton Woods era. Before that, it was the pound sterling that was the global standard, and World War II shifted that to the dollar standard. And there were three reasons why that happened. One was economic. The U.S. was by far the global powerhouse, especially coming out of the World War, where everything else was in ruins. Secondly, we were the largest creditor nation, and so countries that wanted to borrow money to rebuild themselves had to borrow in dollar terms because we were the only country standing. And then third was military. The U.S. at that point had basically the only military worth anything in the war. The Soviets and us. And so those are the three pillars, really. And if you think about what has happened to those three pillars over the ensuing decades, what's happened is that in terms of military affairs, the U.S. is no longer complete and dominant. The Chinese and the Russians have been developing hypersonic missiles against which we have no defense. The Obama administration spent 8 years deploying gender-neutral bathrooms instead of trying to develop next-generation missile technology, military technology. So we've really, there are think tanks in Washington. The Heritage Foundation had a piece that basically within 5 or 10 years, the U.S. military will lose our advantage in all sorts of different categories of military effectiveness. Now, that doesn't mean that it can invade the U.S. It just means that it's harder for us to project power out into the world the way we've been used to since Bretton Woods, essentially. Secondly, the U.S. has gone from being the biggest creditor nation to the biggest debtor nation. And so we don't have the capital we had back then to order people around. And then thirdly, financially, we're still there in terms of most global debt is still done in dollars, but the euro has been chipping away at that, and China's trying to create a Chinese currency zone where they are. And foolishly, the U.S. used its power to kick countries out of the SWIFT system, like Iran, which regardless of what Iranian policy vis-a-vis Iran, it sent a signal to Russia and other countries that using dollars is very, very dangerous. And so again, Russia and China are two big rivals, have been busy setting up their own financial infrastructure, which then they want to deploy regionally. So we're losing also the financial backing. And so when you look at it, you say, well, you look around the world, you see, Argentina's economic policies aren't really all that different from ours, right? Mm-hmm. And so why is their currency completely collapsing and ours isn't? And the answer is, again, because of those three pillars I mentioned coming out of Bretton Woods. But to the extent those go away, I think the U.S. winds up in the Argentina position at some point if we could keep going down this path. And so that's the larger reason why in a panic in the past, of course, everyone ran to dollars for those reasons. And to the extent that those reasons are no longer operable, there will be a point, again, I don't know if it's going to be this coming panic or an ensuing one, but there will be a point where the panic takes the dollar down and not up, and goes flying higher when this all happens. So that was the point of the paper, is just thinking about just more deeply the structure of markets and the structure of currency. And the fact that, again, I always come back to looking at the gold price is really the wrong way to do it. The reason why the market has selected gold as money for the past 4,000 or 5,000 years is because it's so stable. And so really, you should be looking at other prices in terms of gold. So the U.S. dollar is very strong right now in terms of gold because of these reasons, and that may not persist.
Mm-hmm. Well, regardless, whether or not we see the short squeeze on the dollar is maintained as a result of this short squeeze. Strong dollar because everybody has to sell whatever they bought in dollars to pay back the margin clerk. As you point out in your letter, you say, and I quote, if the dollar's value cannot be maintained by an international short squeeze, the markets will look instead to the Fed's balance sheet, and the story there is dire, end of quote. So I guess what you're saying then is those three pillars, to the extent they break down, that could be the reason that is different this time, I guess, right?
Well, that's right. So all a bank really is a balance sheet, right? And again, the quintessential example is the Bank of Amsterdam, which opened its doors in 1609. You show up with your gold coins. They give you notes that represent those gold coins, and so there's a one-to-one relationship between the notes and the gold. And so when you wonder, hey, what are my notes worth? You look at the assets of the bank. And the fact is, the central bank is really not relevant to the question because economics trump politics at the end of the day. Uh-huh. So all the Fed is a balance sheet. Now, again, for long periods of time, depending on how powerful the politics or the country is, you can have politics override that. And so that's what we've had. We haven't had economic forces shaping the value of the currency for the past 60 years. It's been these political factors, military, financial, and economic. But to the extent that those go away, then what you have left is, you say, well, what is a dollar at its essence? What is it? And again, as you know, originally in 1792, the first Currency Act, it was defined as a certain number of grains of silver, and that was shifted to gold in, I think, 1900. But what is it now today? And what it really is, in its essence, is a unit of liability of the Federal Reserve. And so you say, okay, that's nice. Well, what are the assets that's backing this liability? And through most of its history, the answer would have been physical gold, commercial invoices, not debt, but invoices, and short-term government debt, 3 months, 6 months, that sort of term. Well, now those assets are mortgage-backed securities, unknown duration, 30-year government bonds. I think the average maturity is up in the 12, 13-year range. And so you say to yourself, okay, is that valuable? Is the debt of Congress, which has this incredible budget deficit and debt, have any value, especially in a rising interest rate environment? And the answer is going to be no. And so, again, as long as the dollar maintains its value as a political entity, those things don't matter a whole lot. But when the power behind those politics start eroding, then all of a sudden the market will look at the economics and say, hey, what is the Fed's balance sheet look like? And the answer is it looks pretty bad.
So let's talk about what might, in your article you stated that that the U.S. policymakers might enjoy a strategic advantage by a radical devaluation of the dollar. And so let's help our listeners and me understand those pillars start to fall apart, and so the policymakers might switch their thinking in terms of what's the best way out of this mess.
Yeah, that's exactly what happened in the 70s, right? I mean, the U.S. for a long time ran a strong dollar policy, and politicians from Kennedy and Johnson said, "Oh, we'll never devalue the dollar. It's a symbol of American strength," and it was true. But the U.S. accumulated so many debts during the 60s and the early 70s under Nixon that finally the only way to get out of those debts was devalue the currency. We owed Europe tons of dollars. We didn't have the money, and so we said, "Hey, we're going to devalue the dollar." And then reestablish it on a debt standard instead of a gold standard. And so we have a very similar situation now, where now the debt is, of course, orders of magnitude larger than it was in the 70s, and we can't possibly pay it back. And then also, but the point I make in the article is that other actors now are piggybacking on the dollar system. So China has a bunch of dollars, and they lend them out to these third world countries like Kenya and Pakistan, these places, knowing that they're going to default. And then when they default, they take strategic assets like ports and airports and things, strategic things like that. And so there may come a time where U.S. policymakers think to themselves, you know what, the only way out of this trap we've constructed for ourselves in terms of the amount of debt and in terms of people like China piggybacking on our system is to devalue it. And that would allow third world countries to pay off China in devalued terms. So it would hamper Chinese imperial ambitions for a time. And it would also allow the U.S. government to pay back its debt in nominal terms. And of course, as you know very well, this is always the end result of countries that wind up too much debt. But the Romans did this, right? They kept debasing their silver currency until there was nothing left, and that was the only way they could afford to pay the military and the bureaucrats. And so there's nothing new about this policy. The only newness is when do the policymakers wake up to the fact that they are trapped and they have to do something dramatic to keep the show from going forward. And I think the answer will be when the financial markets collapse and they can't fund themselves because tax revenue dries up. They may say to themselves, hey, the only way forward is to start printing the money, like big time, helicopter money.
And very, very possibly, I mean, it seems to me that the Chinese, for sure, and some other countries started to become concerned about the dollar big time after the last financial crisis. And I'm wondering, Dan, I think you would probably agree with this, that in order to have the world's reserve currency, you have to orchestrate chronic deficits so that you're always putting out a massive amount of money floating around a massive amount of your currency floating around the globe so that there's enough liquidity. I mean, one of the excuses that everybody gives why the dollar can never not be the reserve currency is that there will be that there's just no other currency that can compete in terms of liquidity and so forth. But Hugo Salinas,
that was Minsky's point, right? And I completely disagree with that. I mean, that is the case if your currency is based upon a debt system, right? Because debt compounds exponentially over time, and you need more and more dollars to continue the system from blowing up. If your currency is based on an equity system, i.e. gold, there's plenty of liquidity for gold and gold derivatives. And I don't mean paper gold like in London kind of thing, but what I mean is the physical sitting in a bank and people have claims to the gold and the equity claims trade. There's plenty of liquidity. And that gold is much higher priced today to make that happen, which will happen at some point when the system breaks down. But so I disagree that a reserve currency is necessarily has to be based on debt, and therefore you have to increase its quantity exponentially to keep this blowing up. You're right, that's the system we have, but that's a bad system.
Yeah, that's the system we have. Under this current system, though, you have to keep pumping more currency out there in order to retain. But then the problem, Dan, that I see is we see all the charts show debt is growing exponentially while GDP, if you even believe the numbers, are growing in a linear fashion. So clearly you don't have to be a rocket scientist to understand that system's going to break down sometime. And now it's even growing more rapidly under Trump. He's spending more than every president seems to spend more than the previous president. So a very interesting picture that I don't know, Hugo Salinas Price, he pointed out that over the last, I think it was 6 or 7 years, the U.S. cumulative trade deficit increased by over 3.6 trillion, And yet the amount of money that's in the central banks, the amount of dollars that held by central banks, actually declined by about 4%. His theory is that already what's happening is the central bank of China and others perhaps, but China being the dominant one, is buying gold with those dollars and leaving it in the hands perhaps of other Chinese citizens, and then they use that money and go out and buy assets around the world, and that the Chinese may be backing out of the dollar system that way. Does that sound like it could be?
I think the Chinese have gotten a lot of mileage playing the dollar system, so I don't think they're going to be the ones to torpedo it. I do think that they've been buying a lot of gold because they're clever enough to know that its days are numbered, and so that they want to play it both ways. As long as the dollar system keeps going, they'll keep exploiting it for their own purposes, and then when it blows up, they'll have gold in reserve to fall back on, and that's a very sensible policy. I think Russia's doing the exact same thing. And also I would point out that don't forget, central banks aren't really the main sources of money creation. The main sources of money creation are the commercial banks, the private banks. They're the ones who lever up assets and do maturity mismatch and have fractured backing, all that business. The function of the Fed is to run in and save them when they blow up. That's their function. So they don't need to print the money as long as the commercial banks are willing to increase leverage, which they are doing. So their role comes later when they got to print the money to backstop them when they blow up, and that's probably not too far off.
Dan, with just a couple of minutes left, with respect to the gold mining industry, which I know you pay a lot of attention to, you made the point in one of your recent missives that at $1,300, most of the mining companies make enough money to pay good salaries and pay their debt, but there's not a whole lot more left over. What do you think we need in the way of a gold price to make the gold mining industry some place that people want to put their capital in again?
Well, I think over 1,300. Look, I'm not a chart guy, but it's pretty obvious. Once we cross 1,350, 1,370, whatever the number is, we're going to go shooting higher. And at that point, what will happen is, and the way markets work is when you don't need the capital, it all comes out of the woodwork. Yeah. And so right when gold hit 1,400, 1,500, and the industry can self-fund itself, then you'll find all the third-party guys running it. And that's when you get a big spike in valuations. It's been painful waiting for that. It's going to happen. When, I don't know, but it will, because gold always goes up in terms of currencies that the government is running deficits on. So it's just a matter of time.
The last credit crisis, of course, China was there in a big way with massive amounts of stimulus, and that sort of increased commodity prices around the world. It helped to pull us out of the dungeon, so to speak. Meantime, as we just noted, they've been increasing their largest gold producer. They've been importing huge amounts of gold from around the world. Do you think that they may not be there to send us a safety, whatever you call that thing they throw out on the water, to save people that are drowning? You think the Chinese...
Yeah, the Chinese are not altruistic, right? 2008, they looked around the world, everything was super cheap, and the commodities were on the floor, and they had money, so they bought them all. But the problem is their economic model is even crazier than ours is, right? They spent the last 20 years building ghost cities and full-scale replicas of Paris and New York and all that crazy things. Everyone owns 4 apartments, they live in one of them. So I don't think China's going to be there, because I think they're on the verge of blowing up as well. Some of their banks are rolling over finally. The economies are letting some of these companies blow up for the first time. So the chances that the Chinese can muster another credit response to bail the world out, I think is very, very slim.
30 seconds left. What should we be looking for in terms of Fed policy to figure out which way this might go?
Well, I think before we started, if you look at the yield curve, it's just going negative again. And it does that usually right before there's a big financial crisis. And because financial dislocation is bigger than ever, I think the crisis is bigger than ever. So I think what you want to look for is, when do the markets force the Fed to react and start printing the money again, and how do they do it? And I think the markets are betting it happens before the end of the year. And that's got to be good for gold prices, I think. So, I'm hoping this funk we're in doesn't last too much longer.
Good for gold prices. I'm not sure how good it is for our national discourse, but that's another issue for another time. Dan, thanks so much for being with us today and helping us understand the really crazy world that we're living in. It's great to have you, as always.
Thanks.